Welcome everyone to the Kendall Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Don't forget to subscribe, hit that like button, and share these videos. Well, the markets had an interesting start to this week as we saw a rally toward the highs around 29.45. In the last 2 hours, we saw the market start to decline sharply into the close, closing unchanged on the S&P. The Dow Jones was negative and the NASDAQ continued its rapid move up. After the close today, we saw some continued selling with the futures being down about 1%. Several days ago, I talked to you about the markets rallying into the opening of the economy, but once it started to open, that it would fade. Well, we didn't even get open. We're already starting to see some pressure come in as the rumors around Wall Street is all of a sudden traders are worried about the opening of America, even though 3 weeks ago, 5 weeks ago, they were optimistic about the reopening of America. I compared this several sessions ago to waiting for a stock to release its earnings, and it was better than expected, but the stock declined. That's exactly what we're starting to see. There is substantial support under the markets yet, so we're far from rolling over, but things are starting to get a little touchy. Over the next several sessions, I'll be discussing the possibilities of the markets rolling over, but underneath this market is substantial support that is built over the last several weeks. I don't see a major decline here, not at the moment, but there is some possibilities growing as the divergence that I talked about in the technicals last night continue to unfold. We'll go through that more in a few minutes. The other situation that I alerted you to last night was watching the 10-year treasuries. They moved up back to around 0.76 and are starting to look like they want to go much higher. There is a risk of the treasuries continuing above the 1% level, primarily as the talk on inflation is getting stronger and stronger with all this stimulus that's going around. The administration is talking about delaying tax payments one more time. I wouldn't be surprised if they give everybody a tax holiday and nobody pays taxes. That'd add about $3.3 trillion plus dollars into the economy right there. This may be part of the tactic as things unfold. As I've discussed several times in the past, I still think there's a lot of events that are likely to come out of this situation that we haven't thought about just yet. So the market action over the next several days is going to be very important. Patterns suggest there's still underlying bid and there's still some possibilities of the upside. But as I've said in the past, this thing will turn on a dime if anybody gets scared for any reason. There's a lot of emotion in the markets yet, so don't be surprised if we start to see volatility kick up again. It's been feeling way too normal over the past several sessions. Let's take a look at the charts and see what they're telling us. Looking at the S&P futures, overnight we're down about 0.83 right now, trading at 28.99, under some pressure, trying to challenge the 10-day moving average. One of the things I've been discussing over the past several sessions is the divergence and the loss of momentum that's happening in ppm 1 and 2. This is evident right here. You see this declining indicator both on ppm 1 and 2. Meanwhile, ppm 3 is accelerating to the upside, which suggests that this 40-period moving average is turning up. And in the opening comments, I was talking about the underlying support in this market. Now it's at basically 2,700, 2694 to around 2715. This is where the support is. Markets could decline to there. It doesn't appear that it will get through the 21-period moving average, which is currently 2845. The pattern continues to climb this wall of worry. We've seen this type of configuration before. Let me highlight this in a previous scenario. This area right here in this, where I'm drawing these arrows, you can see where the 10 and 21 period moving averages came in and continued to move higher. we're probably at the early phase of a pattern like this with the 40 or the green line turning up. That's exactly what was happening back in that period of time. You can't see the angle, but these indicators were declining during this period of time. So this block right here, starting around this level here, is what we're representing right now over here. So we have this decline, and then we have this slight upward slope in the 10 and 21 day moving averages. This is a classic pattern. If a close below the 2845 level was rendered, then it would suggest that we could decline down to the 2694 level, but right now the probabilities for that to happen is only 40%. So any declines that we see over the next 2 days should hold. This is what I was referencing in the opening comments, that there's an underlying bid will remain in this market. Now there may be some weakness, but it doesn't appear that it's about to break down yet. This could change depending on how we close and how the configuration unfolds over the next couple days. The other thing I have been discussing is this larger pattern with the big move down to the 2100 level. Now we've had this move up. There's going to be substantial amount of resistance right at these moving averages, the 21 and 40 week moving averages. Also the 200-day moving average on the cash market is right above 3,000, and on the futures it's 29.97. So we're seeing a lot of resistance here. We may look back in hindsight and realize that this was the top of this pattern. Typically, if we're not going to get a V bottom where it just goes straight up to new highs, what we'll see is that configuration. I'm going to revisit something I talked about a number of weeks ago, that we'll see this consolidation. I believe this still makes a lot of sense. We're starting to stall here. We're at the point of completing a 5-wave minor pattern on the daily, and this would represent the 5-leg up would be 5 legs within an ABC, which would be a 3-3-5. I can go into more Elliott wave analysis on the live cast on Wednesday. If you ask the questions, you'll trigger me into a mini class. Still likely the pattern to unfold. We'll end up in this broad range, couple values around 2400, and there's a lot of support lines. If I brought up the Fibonacci grid, you'd see exactly what we're talking about here. The last market I'll cover tonight is the gold market. We continue to trade in this sloppy range. Most important thing out of this pattern is the ppm3 is accelerating sharply. It's actually at 0.317, which is a very strong underlying trend. And this represents this 40 period moving average. So 1673 to around 1690 is major support. Right now, there's less than a 30% probability for gold to drop below that level, but the pattern suggests that we're not ready to rally yet either. This ppm2 still losing momentum, it's negative, and ppm1 is also negative. Similar patterns we're seeing in a lot of these markets that rallied. We're seeing these ppms and these downward slopes. We're starting to see ppm1 to break through its first derivative. Should the market continue to consolidate and ultimately break above 1737, I've been discussing this number for a number of days now. This is your key pivot number. Above that level, then you're going to see the 1820 plus levels on gold. So overall, this pattern is still very bullish. Looking at the weekly chart on gold, everybody knows that this little wedge is set up here. This is the chart that's telling us that the market's not ready to rally yet. PPMs are just collapsing here. See PPM1 straight down, losing a lot of momentum, but still positive on PPM2, but that is the 1622 level. This is the angle of the 21 period moving average. The 40 is also, this is weekly now, are also strong up, so the underlying trend is positive. While this pattern doesn't appear to be ready to break out yet, it's still a very bullish pattern. This will end the broadcast. Thanks for watching. We'll talk to you tomorrow night.